So let's welcome Brendan.
Thank you. So the fund I run, the Direct Lending Income Fund, buys short-term, high-yield small business loans from online lenders. Right now I buy from 4 lenders, and I buy and hold a pool of loans. The loans are 6 to 18-month loans, and they're repaid daily or weekly. I started the fund because small businesses significantly overpay for credit. I was personally an investor in the Lending Club broad-based fund very early on in its life. I was a participant in April of 2011, pretty much waiting for them to get bankruptcy remoteness in place before I participated. And I really liked private credit, and in particular I liked this sort of rebirth of private credit, this movement towards what I call private credit 2.0. Which has much more transparency, the duration is very short, and in general, it feels like a more secure product for investors to own. So I wanted more underwriters, and I spent some time on Google looking for small business lenders, because I believe that that's sort of an adjacent space. So the Cleveland Fed published an article that a lot of folks use to help explain why there's this giant tailwind in small business lending. And the tailwind is really driven by the decline in small business lendings. And I think what most people are surprised by is to find that that decline significantly predates the Great Recession. So this is not a trade, right? The absence of banks in small business lending is a part of a new landscape in which banks, instead of being focused on the communities, are focused for the most part on the Fed. And the result is kind of a huge tailwind for business lending. So I buy from 4 platforms. When I have conversations with the platforms that I buy from, they're not platforms that in the conventional sense. So when I had my first conversations with IOU Central, they were a spread lender. And what I tell spread lenders is, okay, right now, you're however big you are. IOU had a book of loans of about $20 million. And what I communicate to IOU is, look, if you want to be 2 or 3 or 4 times as big, you can continue to raise equity capital, renegotiate your credit facility, and just continue to be on this sort of capital raising hamster wheel. Or you can embrace the path that Lending Club and Prosper have set the industry down, which is towards platform lending. Platform lending, I think, is much more attractive because it's not dilutive as you scale. And as a result, even though I'm a much more expensive source of capital than a spread provider, it's actually still better for the platforms to work with me. So that's a very magical equation. I can be more expensive than another source of capital, but because I'm not looking for them to have equity behind it, it can actually be better for them to work with me. It's a huge win for me and for the investors. Okay, so this is why they'll sell to me. Let me talk a little bit about the loans that I own. They're really geographically dispersed, as you'd expect. These are neighborhood businesses. So small businesses in 2012, the average SBA loan in 2012 was $337,000. My average loan is $41,000. So when you think of a small business, most people tend to think of the businesses they see on Main Street. Those are not small businesses. Small businesses are in industrial parks. They occupy half floors of office buildings. Neighborhood businesses are significantly smaller, and it's the neighborhood businesses that are most underserved. These people just pay a lot to borrow. So this is an example of one of my lending providers. You can see the average size of a loan, $41,000, pretty small, and yet bad debt pretty low. Gives you a sense of what the portfolio looks like. In the case of IOU, they structure their loans in a way that's somewhat interesting. They'll have an interest rate, and then they'll have what's called a guarantee fee. So kind of like a mortgage will have optics to the borrower where they'll have points, and then they'll have an interest rate. A lot of small business loans will have features like that, where there'll be points and an interest rate, or the interest rate isn't discussed so much as it is talked about the amount that you're going to repay. So a borrower borrowing $100,000 in a 1-year amortizing 30% interest rate loan would actually only pay about $15,000 in interest. So the thing is, as investors, we know that when we get the principal back, we can redeploy it. Whereas the borrower sort of thinks of this 30% interest rate loan is kind of a 15%. So it's doable from the perspective of a borrower. They get $100,000 today, they pay back $115 each day over the course of a year, and they're able to buy a new pizza oven, get a new dental chair, buy the inventory for the summer sale season, whatever it might be. This is just covering some of that. Very rapid, but still a lot of human intervention in the process. So this is not full automation. These loans are actually underwritten by real people. It's just done in a week instead of in the 3 months or so that a bank might take. This gives you a sense of the borrowers. Most people are surprised to see how high the quality is of the borrowers here. We're talking about people that have been in business 12 years, 51 years old. They've been protecting an excellent credit rating their entire life, and they run $600,000 to $3 million businesses. So these are generally surprisingly good businesses. And again, this highlights the hole that these businesses fall into, where they just have a lot of difficulty borrowing because they don't fit the W-2 bucket that a wage earner would allow a wage earner to borrow from a LendIt Club or Prosper, and they're still not bankable. In terms of how the underwriting is done, you can kind of think of the business's cash flow as being their ability to pay. So we're not looking at income statements and balance sheets. We're actually going straight to the bank records themselves and assessing the business based on the transaction flow in and out of the bank account. So we're looking for reasonable transaction volumes. We're looking for retail businesses. A retail business should have a reasonable daily balance. It should have a large number of monthly deposits. It should have few negative days, that sort of thing. And I put this up here at the end. We've done very well. These are unlevered returns net to investors. I think when I started this in 2012, it was my expectation that returns would be about where they have been. And I believe that in 2014, we should be able to continue this. All right, thanks, guys. Appreciate it.